Hello, this is Jerry again from ForexTradingMagic.com and trading the laws of charts and men. Okay, this is lesson 3, and in lesson 2 we covered where we would place our stop after the reversal or pivot bar indicated that we should enter the market long or buy the market. And then we discussed how our stop would go below the low of the swing bar. And we also discussed how if we bought at the close of the pivot reversal bar, then our risk goes up, because now the market has further to fall before it falls below the range of our pivot, which would signal a further downward move, as we can see over here where the market finally broke below the low of the swing bar, and that signaled the end of that bullish or upward pivot reversal that began here and carried price down further, for a couple of bars at least. And we can catch some pretty decent size moves this way, 50, even 100 pips sometimes. But more importantly, these pips can be captured on a consistent, steady basis. So now, really, we want to enter this trade as close to the pivot point as possible, or as close to the low of support, which is the low of the swing bar, if we want to buy along this market. We want to buy somewhere in this range, because let's just say if price pull back to the close of the swing bar, now our stop shortens from here to here. So sometimes we may not want to risk very much, and so we'll say if the market pulls back to the open of the swing bar, then we'll enter or buy long. And that will be the perfect situation, or the most optimum time to end, if you can wait for the pullback to that level. And many times price will shoot up and not pull back to that level, and you will miss a lot of good moves that way. But the moves you do catch this way will have a much higher probability of success. And so if our stop is at the open, then our range of our stop falls to around 25 pips. And then that's how we decide our risk-reward ratio on a trade. I mean, does my potential profit or potential reward on this trade, is it enough to warrant the amount of risk I'm about to take on the trade? So maybe at 100 pips I can't enter that trade. Maybe at 50 pips I can't enter that trade. But now at 25 pips, that's a good deal. Especially now, if I can capture 50 pips, that's a 2-to-1 risk-reward ratio. Now, if I can have a 2-to-1 risk-reward ratio on a consistent basis, I only need to be accurate on 60% or 6 out of 10 trades to be profitable. And therefore you don't have to be perfect, and the key is to keep your losses or your stops very small in relation to your potential profits. And usually off of a particular support level it's not unusual to get about a 40 or 50 pip bounce off of it into the other direction, even though price, as we see here, still has the potential to continue back down. We're talking about a bounce, and we'll get more into bounces and reactions in further lessons down the road. And so now here on this particular trade, if we had entered on the open of the swing bar, then price fell about probably about 12 pips below the entry price. So I can't get this line like I want it. So price fell below your entry point, which is the open, but it only fell below it by about 10 to 12 pips, and then it sprang up for about roughly 50 pips, which would have met our target range as far as a trade qualifying within the most optimum risk to reward ratio of 2 to 1, meaning for every dollar we risk, we want to have a profit target of $2, hence 2 to 1. So now we know that our stops can be arranged from anywhere of the pivot point all the way down to the low of the swing bar, and we've seen that some illogical entry points hoping for a pullback after the breakout or reversal pivot bar of the high from the swing bar. After we see that, we know price will continue up, most likely until it reaches the next level of resistance. And that brings us to, where do we place our profit targets? How do we determine where we will take profits? Because we don't want a winning trade to turn into a losing trade, and we don't want a large or acceptable profit to fall to a small or unacceptable profit, because when that happens, even if we are profitable on that trade, we still have a tendency to feel as though we lost, because that paper profit we had most likely already spent. Okay, I'm running out of time on this lesson. This is lesson 3 of the How to Trade Pivot Point series from Trading the Laws of Charts and Men. And in our next lesson, we'll talk about how we project or set our target levels, so we know the best time to exit the trade and what profit we're most likely to get out of the trade, and thereby we can determine our risk to reward parameters. And each one of us can only determine for themselves how much of a risk that we are willing to take. But the important thing is that we know the parameters of our risk, and we know exactly what risk to take, and we will exit the trade when we're supposed to exit the trade. Okay, this is Jerry. I'll see you next time in lesson 4 of trading pivot point reversals, and we'll talk about setting targets. Thank you.